If you think paying people is simple, you hand them money, they go away, you are adorably naive. IAS 19 forces you to account for money you have not even spent yet for people who might not even work for you in 10 years. It is arguably the most annoying standard in existence because it forces us to play God. We have to predict inflation, mortality rates, salary increases, and how long our staff will tolerate us before quitting. The IASB decided that a promise to pay someone a pension in 2050 is a liability today. It's not accounting, it's fortune-telling with a spreadsheet. If you find this logical, please seek professional help. To understand why this headache exists, let's talk about dating versus marriage. Imagine you were dating someone. You buy them dinner tonight. That is a transaction. You eat, you pay, transaction over. You sleep soundly. Now, imagine you propose. You get down on one knee and say, "I promise to love you, support you, and buy you a house in the Hamptons when we retire." Scenario A, the smart way. You open a savings account today. You put $500 a month into it. You tell your fiancé, whatever is in this account when we retire is what we use for the house. If the market crashes and we can only afford a tent, that's your problem. You sleep soundly. Scenario B, the IAS 19 nightmare. You promise a specific house in the Hamptons. Now, every night you have to stay awake calculating. How much will real estate cost in 30 years? What if I lose my job? What is the likelihood we get divorced? What if one of us dies early? If the house price goes up, you are technically poorer today because your future obligation just got bigger. You have not spent a dime, but you feel broke. That is the torture of IAS 19. Let's translate that domestic terror into corporate speak. The scope of IAS 19 covers almost all forms of consideration given to employees, except for share-based payments. Here is how the standard categorizes your misery. 1. Short-term employee benefits, the dinner date. These are benefits expected to be settled wholly within 12 months, like wages, salaries, paid annual leave, sick leave, bonuses. 2. Post-employment benefits, the marriage proposal. This is the beast. These are payable after the completion of employment. IAS 19 splits this into two camps. 1. Defined contribution. The entity pays fixed contributions into a separate fund. The employee bears the risk. If the fund performs poorly, the employee retires poor. The company has no further legal obligation. 2. Defined benefit. The entity promises a specified retirement benefit amount. Here, the entity bears the risk. If the fund performs poorly, the company must top it up. This requires actuarial assumptions. You must recognize the full liability on the balance sheet discounted to present value. It usually results in a massive liability that scares investors. Why do we do this? Because in the old days, companies promised massive pensions to workers but did not set aside the money. They looked profitable on paper but were secretly bankrupt. Write down the bottom line before you forget it. Liability follows the promise, not the payment. If your company has a defined contribution plan, you are safe. You pay the invoice and go play golf. If your company has a defined benefit plan, you are tethered to that liability forever. You are carrying a backpack full of bricks that gets heavier every time interest rates drop or people live longer.